Singapore has kept its 2026 growth forecast at 2 to 4% after a stronger than expected first quarter. But risks from the Middle East conflict are rising, with analysts warning of weaker AI demand and softer hiring if tensions drag on. Nasyrah Rohim with more.
Singapore's economy beat expectations in the first quarter, powered by a surge in wholesale trade and manufacturing. The key driver, strong AI-related demand. But analysts warn that if the conflict in the Middle East drags on and disruptions around the Strait of Hormuz affect supplies, semiconductor production could suffer. That's as the sector depends heavily on helium.
The sector has been coping with continued production using existing helium inventories, as well as some recycling technologies to reuse these helium inputs. But of course, the downside risk is that the longer that the disruption, the Strait of Hormuz is being prolonged, some of these inventories are being drawn down, and that might, eventually hamper the AI-driven electronics production and momentum.
The latest figures also show that employment gains slowed to 8,600, compared with 20,800 in the previous quarter. Analysts say this is due to seasonal factors and that the labour market stays resilient. Still, the Manpower Ministry says it remains cautious about the outlook ahead amid geopolitical developments and weakening hiring sentiments. Last quarter, the manufacturing sector recorded a nearly 23% increase in retrenchments. This is despite expansion in some clusters like electronics.
The Hormuz disruption is the immediate trigger. No feedstock means less production, means less headcount. But chemicals went into this conflict already weak. So business sentiment in this cluster was the softest of any manufacturing sector, even before the war. The war didn't create a fragile sector. It hit one already under stress.
The road ahead is expected to be bumpier for some industries, with the disruptions to shipping through the Strait of Hormuz driving up prices. MTI says this has increased inflationary pressures.
Weaker consumer sentiment following the Middle East conflict may weigh on retail trade, as well as the food and beverage services. Government support measures, including the earlier disbursement of CDC vouchers in June 2026, should help cushion the impact.
The government adds that these factors will weigh on global economic activity for the rest of the year.
And for more analysis, we're joined by Chuan Teck Kin. He's the head of research at UOB. Teck Kin, firstly, Q1 posted stronger than expected results. What is Singapore doing right in the AI space that has helped the economy stay resilient?
Right. So we have this semiconductor industry. It's quite a complete one, although we don't do really sophisticated stuff. But we do operate part of the supply chain. For example, from equipment manufacturing, equipment that's used for semiconductor manufacturing, and also down to in terms of chips packaging. We also have this semiconductor manufacturing capability as well in Singapore, right? So as a result of this stronger AI demand, so the supply chain itself is being pulled along as well. And that's the reason why I think our results have been so good, and the electronic sector has provided much of this support for the Singapore economic activities this quarter.
From your perspective, how durable is this AI boost for Singapore over the next few quarters, and what could trigger perhaps the sudden pullback in AI spending?
Right. So if you look at the demand itself, right, the demand for AI, now we're talking about schools, governments, companies with very strong demand. So for the foreseeable future, in the next 2-3 quarters, I think the demand should be continue to stay strong. For example, recently in the recent budget, Singapore government announced this AI council. Right. So there's a substantial investment. Other governments, other countries, companies are doing similar things to ensure that people, employees and workers are able to command this AI knowledge. So this AI demand for the foreseeable future is likely to continue to stay strong, and that will benefit Singapore as a production hub, as a supply chain hub related to semiconductor and also AI manufacturing. Now, what are the downside risks? Of course, if you look at much of these investments, in AI are being driven by expectations of further earnings growth, ability to generate profits out of this sector by companies like Meta and all those related companies, right? Those are AI companies. So if, let's say, the visibility of the earnings, let's say there's a change in visibility, not as profitable as people thought it would be, then that would be considered, some downside risk in this kind of situation.
Now, the 2026 growth forecast was maintained for between 2 to 4%. It's pretty cautious, don't you think, despite the good numbers?
Yes, that's right. So what happens here is this first quarter has been quite well, 6%, much better than most of the people expected, including ourselves. But at the same time, the government is actually maintaining this 2 to 4% range because of the second half, right? So you have a combination of factors as well, not just the AI demand that is strong, that is looking good and rosy, but we have to be mindful of the downside risk rising from the Middle East situation, energy-related pressures, right? That could still be with us for some time. We don't know how long it's going to be. So to be cautious, I think 2 to 5% range is pretty okay because our forecast, we upgraded, is about 3.2%. So right at the top end of the range compared to 5% last year. So we're in a pretty good space, actually.
Now, core inflation eased more than expected in April, but imported cost pressures could rise because of energy supply disruptions. From your perspective, has inflation already bottomed out?
I think it is not bottom out yet at this point because I think these cost increases likely to continue to work through the pipelines into the coming months. Because, for example, in terms of electricity prices, it is pegged to oil and gas prices as well. So we only reflected in the quarterly adjustment, and then perhaps the next quarter adjustment, there could be some increase, some more increases because of these price pressures. But at the same time, we also have to take note that the supply constraint that we are facing, right, that is even more real because of the disruption in production and also shipping in the Strait of Hormuz. So we do have to be mindful of that the price pressures are still building in the system in the next coming months.
Now, looking towards July's monetary policy decision, do you expect the MAS to keep the policy settings unchanged because of this result?
Well, our view is that I think because of what we discussed just now, the price pressure may be still working the pipeline. So I think the MAS will be biased towards towards a tightening part of the policy, because today's numbers you already show the import costs have the pressure continue to be there. We need a stronger Sing dollar to offset some of that pressures.
Many thanks for that update. Thank you. And we've been speaking with Suan Teck Kin. He's the head of research at UOB.